Well, this week represents the 10-year anniversary of the bottom of the last bear market back in March of 2009. So I suppose it's a little bit fitting that today we had a little bit more of a chaotic type of a day. We actually hit 3-month highs at the beginning of the session on the S&P 500 and the NASDAQ, but by the end of the day, all the indices did roll over. Good news is we didn't close at the lows, but nonetheless, we have some more precarious kind of hanging man types of candles up there at resistance areas that we need to be a little bit more concerned with. So we're going to take a look at all of that price action. We're then going to take a look at a healthcare name that's gone essentially nowhere for the last 3 months, and we're going to take advantage of that pattern by selling an iron condor against it. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's March 4th, 2019. First of all, if you are new, welcome aboard. Remember to go to our YouTube channel and click subscribe. While you're over there, check out our description area where you can sign up for our email distribution list as well. In addition to that, we have a heavy presence on Twitter. We would encourage you to follow us there. My handle is @BrandonVanZee. And anytime you see these videos posted on Twitter, we would encourage you to click like and retweet if you'd like us to continue to do these videos going forward. We also have a heavy presence on Facebook. Feel free to join us over at our group at the web address embedded in the logo in front of you. All right, with that, let's go ahead and dive into the charts. As you can see, I've got chart 4B pulled up in front of us for those of you that are premium market scholars that want to follow along at home. So we'll go through our typical routine of kind of reviewing some of the price action within the various markets here today. This is my third presentation of the day. As I kind of mentioned last week, I'm filling in for David here tonight on Monday when I normally wouldn't be. Remember, I typically teach 2 trading rooms to my premium market scholar students on Mondays, and so this has been a very busy day for me, so I'm going to hope to get this video done in a little bit shorter time than I normally will. So with that out of the way, let's go ahead and get through it. You can see that the S&P 500 was down 0.39% at the end of the day. Now things were a lot worse at the the valley of the day, so to speak. In fact, if we come over here perhaps to the trade tab and take a look at SPY, you can kind of see that on SPY we touched as low as 276.84, and that would have been at around 11 o'clock my time, so it would have been about 1 p.m. Eastern time. So it was pretty ugly at that moment, and I happened to be in my top-down trend trading class at that time, and the students were all notating along with me how some of our tech stocks had been getting trashed here today, especially some of those high momentum tech stocks that had been in favor for much of 2019. So we'll want to keep our eye on that developing story, but the good news is from a broad markets perspective, it really wasn't a terrible day by any stretch of the imagination. Keep in mind that the S&P 500 started the year back here at about 2,500. We're just a hair below 2,800 here after 2 months into the market. So things are still going reasonably strong, but it is also true that at some point trends give way to new trends, and we always have to be mindful of that and be on the lookout for potential holes in our thesis. And right now, despite the markets still going higher and the path of least resistance to the upside, according to the 30-day moving average in this particular case, do note that the candle that we have up here does resemble that hanging man candle pattern where we have kind of a long lower shadow with the head on the top there, and we're up at a resistance area, or at least a perceived resistance area. Now notice that the high label is pointing at today's candle, so it is a reminder that we did hit an intraday high on a 3-month basis today on the S&P 500, but by the time we closed, which is kind of in the lower right hand corner of that body of the candle, we actually did not close at a new 3-month closing high. So a little bit of a mixed signal, I guess, from that perspective. But you will notice that we had a bit of a bearish engulfing candle. Let me right click on this chart and maximize it so you guys can see this a little bit better. Notice that the body of today's candle did engulf Friday's body, and that is generally perceived bearishly. Now, obviously, some of this stuff needs to be given a little bit of time, a little bit of breathing room before we jump to conclusions and just assume that the market is done with its current uptrend. But we do want to pay attention when we start having some of these types of little bit more bearish candlestick patterns like we've seen right here, especially considering, like I mentioned last week, we do have a bearish divergence that took place here pretty recently with the near-term line down below on the market forecast, where we had those lower highs when price was going up at the same time. And I would expect, we'll just have to see what tomorrow brings, but it almost looks to me like this is setting up for yet another lower high on the blue near-term line down below here. And if that's the case, again, we've got another high candle here compared to this prior peak, which would have been right here. It's just slightly more, so it's not dramatic, but nonetheless, we're starting to get a little bit more wear and tear on some of the indicators down below. And after so many weeks of upside for the markets, I don't think any of us would blame it for taking a little bit of a breather eventually. So we'll keep our eye on the story, but right now do be aware that there are some of those bearish elements that are creeping in, and it's not to the point of distorting our posture yet. The posture remains bullish, but we're just going to keep our our eyes on those situations because we don't want to be caught blindsided. So anyway, you can see here that the Dow Jones was down 0.79% today. Again, similar type of a candlestick formation up there. Same thing can be said with the Russell 2000. Russell 2000 was actually down 0.89% today. So that was the biggest loser of these four equity indices that we look at here. And then the NASDAQ Composite was down about 0.23%, similar to the S&P 500. It did touch an intraday 3-month high here before kind of rolling over there a little bit on the midday basis. Another thing that I would mention here is remember that these labels on the chart, they will be either blue or orange that say day range and ATR up there. Remember, they're coded in order to turn orange when we have an outsized range day. They're coded to turn blue when we have a moderate range day. And so today is a reminder with all of our charts in the orange up there on that label to tell us that today was a pretty big day. It was a volatile day. In fact, the VIX was up really dramatically at one point. It did settle in by the end of the day, but the VIX, if we pull that up real quick, you can see that it was up and over its moving average at one point up here close to 17, and then it settled back down to 14.63. It was still up about 8% on the day, but it was up a lot more on an intraday basis. So we did get a little bit of a creep higher there on the volatility measurements. Nonetheless, it's worth noting that we did have a little bit more of a wild day today than we had been accustomed to late last week. Now, David, I think, gets home from his vacation on, I believe it's Wednesday. It's either Tuesday night or Wednesday, so I'll be with you tomorrow again. But he'll take over on this video on Wednesday. And the inside joke is that whenever David goes on vacation, typically the markets get really bearish. We've been lucky enough to avoid it up until today, but who knows? Maybe it was saving its best stuff for the last. So as he comes home from vacation tomorrow, maybe we'll get another spillover effect there. But nonetheless, markets do remain with bullish postures from an intermediate perspective, despite some of the shorter-term turbulence there. From a 3 green arrows perspective here on chart 4C now, notice that it's not a surprise from this perspective, because remember, this was the case on Friday and on Thursday as well, where all 4 of our charts here have a mix of green and red arrows. They had a lean towards the positive side, so if you were going to go one direction or another, they were closer to 3 green arrows than 3 red arrows. So it's not a big surprise to me to see that we had a down day today, and it kind of maintained that lack of 3 green or 3 red arrows. Right now, we're kind of in no man's land where, it's really the MACD that's the problem child of the indicators. You can see the MACD has the red arrow on all 4 of these charts here, whereas we are retaining green arrows on the stochastics on the moving averages. So right now, we still are above those rising moving averages, which is a healthy sign, but we would certainly welcome back a bit more momentum to the upside to feel a little bit more comfortable with trend trades. If we take a look at our 1040 crossover method, this is chart 4D. Reminder that last week was a pretty significant week from this chart's perspective because last week we did have bullish crossovers on both the S&P 500 and also on the NASDAQ composite. Since the Dow Jones already had the bullish crossover, that means that the only one we're waiting for to get back to that positive longer-term mentality would be the Russell 2000. And you can see we're inching our way back towards that crossover status there as well. But of course, if this week ends up being an ugly one, there are no guarantees that that will have a positive crossover. It's just that the chances of it are probably greater than not because you do have enough kind of upward price trajectory where you remember that the moving averages themselves are lagging indicators. And so they're going to be working not just on what's happening this week, they're already kind of taking into consideration the candles prior to this week. So we'll likely see a bullish crossover on the Russell 2000 when the 10-period exponential weekly moving average crosses up above the 40-period exponential weekly moving average here in coming weeks. But for right now, it does have that bearish crossover, and the other three retain that bullishness there. And remember, these are 3-year charts that we're looking at in this particular case. Each one of the candles are 1 week in length. All right, let's skip over the 12-grid analysis today just simply because I went through a lot of that regularly last week since I was with you a little bit more often since David's on vacation. Let's kind of mix things up here a little bit and let's go over here to the ratio charts instead, chart 4i. Take a peek at what's been going on with that lately. You know, and the way you kind of read these ratio charts, you can kind of see we've got 12 different ratio charts set up here, and the labels will tell you what ratio they represent. So as an example over here, up kind of in the black font, it says oil/gold. So it's oil divided by gold, and how you would read that on the chart when you see the candles going up like we have since basically the beginning of the year, it means that oil is outperforming gold on a ratio basis. And so as we look at these different ratio charts, I would say that they mostly represent what you want to see if you want the markets to remain bullish. In other words, you're seeing the more risk-on portion of the ratio outperform the risk-off ratio part. And so, you know, typically when economies are you know, firing in all cylinders and stock markets are going higher, you want to see oil outperforming gold. You want to see commodities outperforming bonds. You want to see stocks outperforming commodities. You want to see stocks outperforming bonds. You want to see stocks outperforming gold. You want to see, actually this one is a little different. A lot of times you would prefer to see foreign stocks doing a little bit better than US stocks. So that one kind of is counter to what you would expect. But down below here, notice this one. Growth stocks have really taken a jump higher here in the last couple of weeks versus value stocks. And it's not as though value stocks are doing poorly. Value stocks are actually doing reasonably well. So it's kind of interesting because for my strategy lab class that I teach on Wednesdays, we kind of focus on the 6 different factors that lead to outperformance of the regular stock market. One of the factors is a value orientation. And we're actually finding that value stocks along with low market capitalization stocks are the trends that seem to be most intact so far in calendar year 2019. So this is kind of an interesting graphic here to show that even though value stocks are doing well, growth stocks are even doing better than it. So what it's probably telling me is that the stocks that are not considered value or growth, or kind of the middle of the road stocks, are the ones that are kind of just meandering right now. But both of these components, from my perspective, seem to be doing pretty well. But it does appear right now that the growth stocks are kind of in one of those up phases here over the last week and a half or so. You can also see over here, small caps are outperforming mega caps, and that is generally a positive sign as well. One of the lingering problems, I guess you could say, would be that EEM continues to underperform EFA, and that's your emerging market stocks versus your developed foreign markets. So think of the developed as, Europe and Australia and Japan, etc., versus your emerging market stocks, which are more like Russia and Brazil, etc. So in a risk-on environment, you would like to see emerging outperforming developed foreign markets, but that is not what we're seeing right now. So, it's not lining up perfectly from a ratio chart perspective, but on the whole, as we look at these 12 different ratios here, I would say that more of them tilt to a risk-on market environment, and that is a healthy sign of the overall stock market. Let's also take a peek at the yield curve chart, which is chart 4J here. Again, just in an effort to shake things up a little bit. Remember, this chart will go back and track the yield curve of all the different kind of durations of U.S. government bonds, all the way from 3-month to 30-year treasuries. And typically what you're looking for are the kind of structured way of seeing the ones with the smallest duration of 3 months have the lowest yields, and the ones with the largest duration of 30 years have the highest yields. That's the way the yield curve should work. But of course, over the last, let's call it 6 months or so, there's been a little bit more conversation around that point, because there will be unique moments in history where the yield curve gets inverted. Now you can see, for example, over here in 2006 and 2007, we had all these little colored lines bunched up all together right there, and that does not look normal, compared to like this normal period here and perhaps this normal period over here. This looks a little bit out of whack because they're all bunched together right there. Now at the bottom of this graph, you'll see that we have a specific spread that just kind of isolates two of them. In this case, it's the 10-year and the 2-year Treasury yield spread, which is probably the most tracked spread out there. And what this is telling you down below is that when this blue line comes down and crosses below this pink line, we have an inverted yield curve from a 2s and 10s perspective. And of course, when you see that blue come down below the pink line there and right there, and even back here, that's when all of these lines are kind of bunched up together. But remember, you can always scan in yourself on this as well. Of course, I'm referencing those of you that are premium market scholars at this point that have access to this particular chart 4J here. What you can do is you can just scan in. So like I've got my mouse over here in 2018. I'm just going to scan in on that part of the chart, because I do want people to recognize kind of where we stand right now. Now, some of these are a little bit wacky here because this data does not get updated on a daily basis. It comes directly from the Federal Reserve, and so Thinkorswim needs to wait a little bit. There's a little bit of a lag time there, but nonetheless, it can kind of tell the story of where we're at right now with the yield curve perspective here. Now, you would expect the red line to be on the bottom, so that is as expected, right? The red line represents the 3-month Treasury yield. The next one we should see directly above it is going to be the yellow line, but notice that is not the case here. So the yellow line is up here. Meanwhile, we've got the kind of the purple and the green in between the red and the yellow. So the purple and the green, purple is the 2-year and the green is the 5-year, are currently yielding less than the 6-month Treasury yield. And again, that is not normal. Usually, the longer you have your money at risk, the more you should be getting rewarded for taking that risk as an investor. But that is not where we find ourselves right now. That is generally perceived to be a more difficult time for banking institutions, and so that's why you're seeing maybe a little bit more deterioration amongst some bank charts out there and their profit-making potential, because typically they want to be able to loan out expensive and borrow cheap. And when the yield curve starts getting inverted in some of the cases like we see here, they're not able to do that as opportunistically as they would want to otherwise. So we do want to keep our eye on that, because it is true that inverted yield curve typically does lead to a turbulent period from an economic perspective, and oftentimes a bear market in stocks will eventually occur as well. But I will also remind you that if we kind of zoom back out for a little bit here, that the last time we had a true inverted yield curve from a 10s and 2s perspective down below would have been the last time this blue line came below the pink line, and that would have been back here in May of 2007. So remember, it really wasn't until the fall of 2008, after that inverted yield curve, before the stock market really started spiraling out of control. And we're not even there yet on the 2s and 10s. We're just there on some of the lesser known tiers of that yield curve. So anyway, just wanted to remind folks of that, since we don't have an opportunity to talk about the yield curve quite as often during this particular presentation. Let's take a quick peek at what sort of sectors we're moving here today. You can see that the leading sector today to the upside was XLB, and that's your materials sector. It was up about 0.45% today. In second place, right behind it, was real estate, XLRE. It was up 0.4% today. So those are some decent gains on a day when the rest of the market was really struggling. On the downside, we did see those healthcare stocks getting hit yet again. I think I mentioned it last week when we had the conversation about the United Healthcare trade, that a lot of those health insurance stocks really started rolling over in a big way last week, and they even continued here today to a degree. And then we've also seen some of the drugstore stocks and some of the biotechs, et cetera, that were starting to bleed into the red a little bit more today. We could take a peek at which stocks within those areas did kind of lead the way. Give me a second here and I'll pull up the materials and just get a sense of which materials companies were doing better than others. We can see that Packaging Corp of America was up over 2%, Eagle Materials was up over 2%, and WestRock was also up over 2%, along with Newmont Mining, of course, the big gold company, and Vulcan Materials there. So all of those are right around that 2% move to the upside. On the downside within the healthcare space, let's see who the culprits were over there. And give me a second to pull that up. There we go. Let me flip this around. There we go. And we can see that ICU Medical was down 6% today. Healthcare plans, or WellCare plans, I should say, was down about 6%. United Therapeutics, so that's your biotech that I mentioned, down 5% there. But yeah, it's a whole bunch of those healthcare insurance providers like WellCare, Anthem, Humana. You could even probably lump in Centene in that. There's United Healthcare right there. So a lot of those down 4% or more today. So that continues to be an area of extreme stress in the current marketplace. Speaking of healthcare, let's now get into our trade application example for the day. And so for that, I'm going to come back on over here to chart 4A to look at the market forecast 1 grid. And I wanted to pull up a stock that's really been just tracking sideways here. And that stock is Amgen. You can see Amgen has largely been just going sideways. You can see that it's topped out, over the last 3 months at just over 205 on the upside, and on the downside, it bottomed out at around 178. And where we find ourselves right now is pretty much dead smack in the middle of those two ranges right there. Although it was important to note that today we did get a bearish posture on Amgen, according to the market forecast. You can see that background color turning pink there to let us know that. In addition to that, we have that hanging man type of a look towards that candle there, where we do have a bearish engulfing candle as well. And of course, we did close right here in the lower right-hand corner of the body of that candle, which would be below that falling moving average. So when that moving average starts getting colored again tomorrow, assuming the price doesn't go back up, that moving average will start turning red yet again tomorrow. So it's kind of struggling to kind of maintain those levels right there. So there's a little bit of a bearish tilt to this one, despite having a little bit more of a neutral feel from a true price range perspective over the last 3 months. Near term, there's a little bit more bearishness that's kind of been creeping in on Amgen. And, according to what we saw there with the healthcare stocks in general today, it might not be an Amgen only issue. It might be just revolving around healthcare. Oftentimes, healthcare has a nice, healthy target on its back because politicians on both sides of the aisles will agree that prices of drugs and pharmaceuticals, et cetera, are too expensive. And so they always kind of have to fight against the politics that we currently find ourselves in. So with that out of the way, let me go ahead and show you what I was thinking on this one, which is an iron condor on a trade that's been mostly neutral, but it will have a little bit more of a bearish bent to it. So typically the way that I set up iron condors, first of all, I go out, look for a monthly contract between 20 and 60 days. April contracts fit just fine there. There's 45 days left in the normal monthly contracts for April. I then want to come over and look for a delta that's close to 20. Now notice we have one over here on the put side of the equation where we have a 20 delta spot on, and that would lead us to the 175 strike. So that's the one that I'll target to sell on the put side. We'll sell the 175, meaning that we hope that this $190 stock stays above 175. But at the exact same time, we're also going to sell a call spread in addition to the put spread we're going to sell over here. And for that, we're going to look again for a delta somewhat close to 20. Unfortunately, this one we can't get as spot on because you'll notice once we get above 200 on the option chain here, it starts moving in $10 increments. Notice that below 200, it moves in $5 increments. So we don't have as much ability to customize our trade on the call side of the equation, so we're kind of just stuck with what we have there. In this case, we'll have to look at the 27 delta and look at selling the 200, which is unfortunate because if the 205 existed, I'd probably look to target that. They do have some of those other ones on the weekly contracts, but unfortunately, I checked the weeklies and they're pretty illiquid over there on the weekly side of the equation for this particular stock. So in this case, we're going to stick with the 200 to sell in April there. And because we have to do a $10 wide on the call side, right, we'd have to sell the 200, buy the 210. Then when we focus on the put side, I want to kind of have that kind of balance there. And so I will look to sell the 175 and buy the 165. Now, for those of you that are not familiar with selling iron condors, what we're hoping to accomplish then by achieving this type of a trade is for this stock to mostly continue to go sideways for the next 45 days. Where we would excel with this particular trade is if the stock closed between our sold strikes. And so we would want this $190 stock to close in 45 days somewhere between $175 on the low end of the scale and $200 on the high end of the scale. Now, let's go ahead and load up our trade to see if we can get enough premium for selling this iron condor. So I'm going to go ahead and right-click on the 175 put, go to sell, and then choose iron condor. That loads up our trade down below where we then do have to start adjusting some of the contracts. So on the put side, remember I wanted to sell the 175, but in order to keep it to be a $10 wide like we're going to have to do on the call side, I do need to adjust this 170 that gets put up there by default to 165. So that way I made that a $10 wide there on the bottom side with the puts. So on the top side with the calls, let's start adjusting that now. So I'm going to change this 180 here to that 200 strike that we identified right there. And then the one directly below it that says 185, I then need to adjust that one to the 210, which is right there. So then we have $10 spreads here on both the put and the call side, and the net effect of all of that is that we would receive a credit of $2.98 here in this particular case. So let's see what sort of return on risk we would receive if we would take this particular trade. If I click on confirm and send right here once, it gives me the data necessary to calculate that. So I'm going to get my calculator out here, and I'm going to take our max profit, which is $2.98. I'm going to divide that by our max loss of $7.02, and you'll see that our return on risk on this one is 42%. A lot of folks will kind of have a target minimum that they're willing to accept of, let's say, 30%. So a 42% would be well above that particular minimum there. Obviously, this is not going to be suitable for all of you. Some of you might have higher standards as far as what your return on risk hurdle is, and you would need to adjust accordingly. But for our purposes here in paper money, this would be viewed as an acceptable circumstance. You can see here that the break-even stock prices are listed here within the order confirmation dialog box as well. So 172.02 on the bottom side and 202.98 on the top side. And the reason those numbers are different than what I mentioned before when I was giving you the general philosophy of the trade is this is now incorporating the credit of 298 that we're taking into the trade right there, right? So if we were short the $200 call strike, then if you take $2.98 and add it to our $200 call price, that's where our break even of 202.98 comes from. And then the flip side of that is if we took 175, which is the put that we're going to be selling, and then subtracted out $2.98, that's where they're coming up with that break-even price of 172.02. But the reason that those break-evens can be important is if you are somebody that looks at technical analysis, you can go back to the chart and just determine at this point if you still want to take that particular trade. So if I wanted to get, let's say a drawn item out here and just go to a line or a price level in this case, I'm going to draw one price level up here at the top. And once I've drawn it, I'm going to right click, go to edit properties, and then I'm going to go ahead and put in 202.98 to give us a visual sense of where our upside kind of range is. And then I'm going to do the same thing by drawing another line down below here, and then right clicking on it, going to edit properties. And on this one, I'm going to type in 172.02, which is our break even on the downside. Now notice that one disappeared because it's off the chart. So I would need to kind of squeeze my chart together like that. But what I mentioned before is true, which is this one will give us more freedom to the downside than to the upside. And I think in this particular case, given the information we know right now, where we just got that bearish posture today, we would want more flexibility to the downside than we think we might need to the upside. Now, obviously, anything can happen, but that's the general philosophy there. But you can see that this upside price range up here would coincide with some resistance areas that this stock has met with in the last 3 months. So that could help protect your trade if this stock went up at some point during the life of the trade. So I'm going to come back over here to the trade, click confirm and send, review it one last time, and go ahead and send that one in. All right, well, I want to thank you for joining me here today yet again. I'll be with you tomorrow. Then David will be back on track with you on Wednesday after he's back from sunny Orlando. Hopefully he's enjoying himself down there. So anyway, markets had a little bit more turbulence today, but nothing extreme by the end of the day because of the bounce that we did see off of the lows. So right now, postures remain bullish, but we do want to keep our eye on some of the short-term conditions and some of the news flow that's coming out that could disturb the markets going forward. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.